Hey everyone, welcome to obviously live Mogul webinar monthly. And right now, Joey is joining. Hey, Mark, how's it going? Yeah, obviously keep the chat open and definitely feel free to reach out with any questions because we're definitely down to answer them later on. Hello, great to be back in the flow. Yeah, I completely agree. It's been a while since I've been on one of these things. Michael's been holding it down for quite some time, which very appreciative of, and he definitely turned on the star power, so to speak. But appreciate everyone joining here. We're giving Joey just 1 second. True to form, he has a ton of technical difficulties where he couldn't reach his camera. So he should be joining on right now, but we'll also give some people a little bit of time to join in. Yes, this is live. Yes, thank you, Larry. This is very much live. We meet. I'm not gonna lie, I do love reading the chat throughout this entire thing, and I'm definitely gonna be looking in there for questions. Obviously, we hosted it on Dividend Day, so big day for us. Pretty crazy whirlwind adventure from 7 a.m. So definitely just trying to. Can't wait for Joey to join. There he is. Is this camera joining?
Can you guys not see me?
Not at all.
Oh gosh.
Is
classic.
Should Michael join in? Like,
yeah, let's get Michael in here. Let's get Michael in here.
Can you add or no? Can he join the stage? All right, you deal with that. I'll run through a few different things. Obviously, if you're joining us, thank you so much for joining us. We can get things kicked off here. Oh,
there
and Mike is in.
I'm in.
A terrifying background.
Saving the day.
Yeah, it's better than Joey's Harvard diploma behind him, but I'll give him that. All right, sweet. So let's jump right into it. I like to start things off with a little brief background on myself and jump right into all things Mogul. Obviously, I'm Alex Blackwood. I'm CEO and co-founder here, along with my co-founder Joey, and along with our director of real estate, Michael. Really excited to jump in with you, especially given the fact that in November and December, Michael is actually taking my place. November was because of some incredible news where we were on Yahoo Finance. So thank you everyone for tuning in. It was actually during NVIDIA earnings. So we actually got a tremendous bump from that. So that was pretty fun. Outside of that, Joey, true, given the fact that he does have technical difficulties, however, he is a business insider, rising star in real estate, which is pretty cool. And I mean, that's very representative of the industry, given how not tech forward the real estate industry is. So obviously, congratulations, Joey, on that. And if you've been watching over the last 2 months, we've been selling out properties left and right. But enough about that. Let's jump into all things Mogul, macro, and with that, I mean, I can turn it over to Joey to give brief background on himself, and then we can round it out with Michael. Oh, and actually, Michael, let's give a brief background on you and jump right into it.
Oh, Joey back in?
Not at all.
Perfect. Wow. Yeah. Okay. I've tried joining from 4 different browsers now. Not sure what the heck is going on. My camera was just working. This is super unfortunate. But as you all know, yeah, co-founder of Mogul here, COO as well. You know, we've been Alex and I have been growing the business for a little over 3 years now, which is crazy to think about. And yeah, I'll pass it off to Michael to give his intro as well.
Yeah, Michael Cazales, director of real estate here at Mogul. Been with the team for about 1.5 years. Really hopped over full time onto the supply side back in July of 25, and having a blast growing this thing along these guys and the rest of the team.
Incredible. Well, I can give a brief update on all things macro, what we're paying attention here at Mogul, and then I can turn it over to Joey, who's going to dive into a little bit more about how that impacts you as a real estate investor. So, I mean, big news this week is obviously Fed Chairman Powell did keep rates constant. He did not cut them. I mean, that was well in line with analysts, which about 97% of people were saying that he would keep them constant. And that is represented in the mortgage rates, which are down to the lowest in about a year. Michael, is that right? Give or take?
Yeah. Yes.
6.1 is the average mortgage rate, down from about 6.99 just a year ago. And obviously that is representative of the fact that the labor market is definitely softening. Inflation, we talk about the 2 pillars that would drive the Fed chairman to cut interest rates. It's inflation basically going down to the 2% target healthy inflation rate. And then the other one would be a softening of the job market. Now, 2.7 right now is the current inflation rate. So as it sits, inflation is still running a little bit hot, but the job market and the fact that unemployment is kind of ticking up a little bit basically made it so that he had to cut rates over the last little bit. And so now he is keeping rates kind of constant throughout it. And I will say I have a few facts here on the side where even though it's 2.7, the inflation rate, shelter costs are actually up 3.2%. And so that actually directly impacts you as a real estate investor. And then outside of that, the market is showing signs of thawing for sure. December was up for sure. And with that, I mean, I can just turn it over to Joey, maybe give a brief background, or Michael, if he has his background up and is on camera. I defer to you all.
Yeah, 100%. I think
Joey take over the macro items for sure.
Yeah, 100%. Then I'll pass it off to Michael to kind of talk about how that's affecting our business plans now and kind of how we're thinking about our current investments. But yeah, you know, as Alex said, interest rates are slowly trickling down. Obviously, the Fed just decided to keep rates constant, which is fine because we're actually seeing our first deals kind of sub 6% APRs on those, you know, 10-year interest only, 30-year fixed products that we originate for every one of our deals, usually around 75 to 80% of purchase price in terms of loan to value, loan to purchase price. So, you know, right now, I think we're seeing a little bit of softening in the market, which is great because it creates a buying opportunity, as we've kind of touched on in the past month or two. Right now, we're definitely seeing some pretty significant discounts across the board, you know, typically anywhere from 5 to 7% plus, coming down from where listing prices are in terms of what we're able to negotiate in our PSAs, further protected and bolstered by inspection contingencies and appraisal contingencies, and financing contingencies as well. And we kind of have the ability to drive those terms right now, given it's more of a buyer's market. So we're seeing a lot of great supply in terms of the pipeline. And when we're negotiating these PSAs live, you know, Michael can talk to this even further, but it's really awesome to see kind of the opportunities and the dips that we're able to buy in now. That way, over the next 5 to 7 year business plan, you can see that growth really start to pop as the market kind of hardens up. But yeah, Michael, back over to you to kind of how that affects current real estate.
Yeah, and I would say it's important to call out, not only do we take advantage of the market conditions, but as we grow as a company, we're also taking advantage of our size. We realize we're a valuable asset to a lot of folks that are turning over new products that they're going to put to the market to sell. And us being an end buyer that is interested in the product and allows folks not to even have to launch on market helps, where they're not having to pay out a buyer's agent commission 3%. We're getting these assets a lot lower to the price that someone would be taking them on the open market. And it's a good relationship where we have contractors in these different markets that are 20, 25 years into the business. We know that we can count on their quality. They're selecting the type of assets and the type of locations that we look for. So all that is really beneficial to us, in addition to the macro environment of a greater buyer's market that we're in right now.
100% agree.
Heck yeah. Well, I am Joey. We got to slow down too. We're getting notes on that. Yeah, definitely appreciate the feedback there. Definitely. I mean, it's hard to contain that enthusiasm. He definitely gets, we all are getting very excited about what's going on here. So completely understand. As for Damien, I hope you are able to stay on now. Obviously, he's sticking around because we do have some surprises towards the end, as is custom with all these webinars. But yeah, I love this chat. I'm not gonna lie. It started out with like 10 people a year ago, and now it's up to near 100, and people are really buying into it. So really appreciate that. Now,
Can we also shout out that we have nearly 100 people in this group? That's just an awesome achievement. I mean, I remember when it was like 4 when we first started.
Yeah, and we kept it going the full, which was a ton of fun. But yeah, now you got a third person on the line with us too. You don't just have Joey and myself going back and forth, or Joey and Joey's JG and my actual camera facing. So with that, I think we should dive in a little bit to the dividends here. I know we have kind of it twofold. We're going to turn it over to Joey to give kind of a high-level overview on the dividends, starting to rebound for sure. And then as for Michael, he can dive a little bit more into the nuances around specific properties. So with that, I'll definitely turn it over to Joey now. And again, keep adding questions in the chat because we will answer them towards the end. We'll leave the last, call it 20 minutes or so for questions. So Joey?
Yeah, absolutely. So December dividends just went out this morning. Overall, really great performance across the board. Right now, breaking it down by product type, we're seeing a shift kind of where we are outperforming a lot of our underwritings on the pad split side, which is really great. Payouts have been really strong, collection loss has been really low, and occupancy is stellar across the board, typically above 92, 94% across the entire portfolio, which is super, super strong. We are seeing an uptick in the trend on the short-term rentals, which is really great. Typical, macro seasonality aside, a lot of the markets that we're in as well are kind of tourist destinations. So when you get into that kind of, March to September timeframe, that's really where you make a bulk of your return. You see a lot of those properties from last year, returning anywhere from 70 bips upwards of 1.2% per month, during kind of some of the warmer months, proverbially speaking and literally speaking. But yeah, Michael, do you maybe want to dive into some of the more specifics around kind of what we're seeing in the market now, where we see it going, and how we're thinking about the business plans?
Yeah, we're very much crawling our way out of the dog days of the STR calendar. Like Joey said, that March to September timeframe is really when you make your buck on this business plan in a lot of markets. Now, we are trying to enter into some more four-season markets, specifically like up in the Poconos, and even Gatlinburg can be argued to be one of those. But a lot of other markets do have their very hot months. And some of the performance of the short-term rental portfolio comes with when we acquired the assets, the timing of when we acquired it to where that bull season is for STRs. And we're having a lot of learnings on our end. There is a little bit of a transition period when you change hands from one STR operator to another. There's permitting that goes into it that halts operations for a little bit on the first month, and all very good learnings that we're iterating off of. We're gathering all the data and we're putting it to action with smart decisioning behind it. I know Alex perked up when I said data there. I saw it. But yeah, I mean, specifically the pad splits, they're kind of the well-oiled machine, and that is kind of what we sought the business plan out to be. The highs won't be overly high, the lows won't be overly low, and it'll chug along. And the STRs, we're excited to see some of the outsized return months coming into form come March and beyond.
Yeah, I'll add too, we're getting, as Michael said, so much smarter about the way that we can collaborate with our property management partners and asset management partners to, really manipulate the algorithms. It's wild to see kind of how the leasing has turned into a total virtual world, right? And all the properties that we operate, aside from the direct leasing, are through, platforms like Airbnb, Vrbo, and PadSplit, right? That all have algorithms according to how they show the properties. And Alex here, being an SEO optimization expert, along with a lot of other members on our team, can understand that a lot of the inputs that go into those listings affect kind of how prominent they are, how bookings come in from a 30, 60, 90-day lens. And we're getting a lot better at manipulating those algorithms to bolster occupancy and average daily rates as well.
Yeah, and I will say that, oh, go for it.
No, I was just going to say, I think one of the learnings are we would lean to the property managers to really be the experts on all things operational on the STRs with price manipulation and rev ops. And we're already expanding our team internally to take full ownership of it in tandem with these property managers. And it's only going to come with a net benefit to how the properties perform and ultimately the investors.
I will say this, we are all invested alongside of you. I am typically the first, if not second, check-in with Joey, and all of our employees here actually paid bonuses partially in property investment. And so our incentives cannot be more aligned than any other platform out there. So I do want to say that and say anything that's happening, whether it be down months here or up months there, we are putting our blood, sweat, and tears into it, and it's getting really, really, really sharp. And I would say on the next few months, especially on the short-term rental side, are looking a lot better. I mean, wouldn't you say, Michael?
Yeah, I definitely agree with that, from implementing learnings and also just the seasons turning as well.
Yeah, that's one thing that I was actually in shock about. A lot of other platforms, I just kind of haphazardly mentioned it during one of the meetings with the marketing team that we were working with. And I was like, oh yeah, I'm invested in every property. And they're like, really? I was like, yeah, I mean, isn't that expected? I mean, it's your product, you're building it. Like, I was in shock when people were saying that other platforms weren't like that. So anyway, I mean, I know we had mentioned that we were going to go into questions later on, but maybe we should dive into some of the questions that are coming in now, and then maybe come back to the surprise at the end. Does that make sense, Joey?
Yeah, it seems like we're getting a lot of good questions. So instead of letting
yeah,
stop, yeah.
I mean, I'm just going to go to the top and kind of scroll down. Jesus, this is the problem with like now actually starting to have a community, is the chat just keeps getting longer and longer. Anyway, so that's, everyone talks about the good of growing, never about the bad. Anyway, can you talk a little bit more about where else these Mogul properties are marketed to? Is there is a second platform / partner? That was from Brad. Who wants to take that one? I think it's on the rental side, right? Like, that's what he's asking about, is where are they marketed to on the rental side, just to clarify.
I would assume so for lease up, correct?
Yeah, I think that's
not for purchase.
Yeah. You want to take it?
Yeah, because on the Mogul platform, we only list our direct properties here. We're not co-listing them anywhere else. And then on the leasing side, on the PadSplit side, we lease them directly through the PadSplit platform, which again has its own algorithm in terms of how properties are listed, how they're leased, how they're operated, and all the communications happen through that one platform, in addition to the payouts and how we manage the listing online. And then Michael, you want to touch on the STR side?
Yeah, I mean, it's really a lot of SEO levers that get pulled for folks that are looking to travel into X market where we have our properties listed. And obviously looking on the Airbnb, the Verbos, for some luxury offerings, there's like a Marriott luxury avenue that folks can book through as well. And we try to blast those bookings through as many avenues as possible, get more eyes on, and increase the occupancy across the board.
Yeah, with the STRs, there's a multiple listing service, if you will, where a lot of our asset managers and property managers use a central tool to put their dynamic inputs into, right, in terms of pricing and kind of targeting occupancy. And then that will get blasted out to the Airbnbs, the Verbos, the Booking.coms, the Marriotts, the direct listings, and so on. And so that's kind of how that works on the STR side. And that way you can maximize your calendar, optimize ADRs according to having a further reach and being able to push that up, and then ultimately better outcomes.
Yeah, not to mention too, obviously with ChatGPT and the rise of that, Google algorithms and SEO, you can't rely fully on it. So that's why we kind of optimize around the different sites and listing there, because Google, I don't know if you noticed, but a massive thing that happened in November of this past year was Google basically cut its main page down to only 10 entries to prioritize its Gemini search. And that actually was a massive detriment to a lot of people in the SEO space. Outside of that, I mean, that's kind of just side note too on the SEO side. All right, so Dylan has one. With the K-shaped economy, are you seeing a difference in the PadSplits and Airbnb properties? Michael? Or Joey?
K-shaped, yeah, I think that's a Joey one.
Yeah, I mean, just with I assume that means like kind of the staggering components of the economy right now, right? Like obviously equities are all over the place, rates are all over the place. Real estate is actually surprisingly holding super strong. But I'll just say, like, with all the uncertainty and volatility that exists in the market today, I mean, cannot stress how much real estate is kind of the go-to asset in times of softening, especially. Buying the dips, getting solid discounts and good cost bases. That way you can operate and weather the storm, whether it is the next 2 to 3 years that we see some stagnation or softening in the market before we start to see some major improvements. Real estate is definitely an incredible place to park your money, right? It's really all about the relative cost of capital and kind of how many percentage points you can earn on your dollars invested, right? So if you're investing in equities and you're aiming for a 2x in a year, the volatility on that is very, very high, and the odds in a softening market that you'll hit that are very, very low. Whereas real estate, it's a private equity investment. You control most aspects of it, outside of the capital markets treatment that happens with things like rates and with exits. But otherwise, you can control the business plan, you can generate cash flow. And that's why, when we're averaging 6 to 8% plus in terms of year one cash on cash yields, we're effectively triage against the current market. And that's how we kind of operate and the value proposition that the real estate provides.
Not to mention too, it's exactly what you're mentioning. I mean, the 10 million plus market cap too for single family rentals in general, or just real estate in general. I don't know if you've seen the market K-shaped, obviously being the kind of top and bottom, like the disparity between two socioeconomic classes. And so if you look at, for instance, today, there was a great article about the fact that 10 million and up homes are seeing the hottest market ever. And then obviously 10 million below, it's still more of a buyer's market. And so that's just something to keep in mind, is a lot of our assets are really kind of that grade A asset type there. But outside of that, if we're talking about, all right, so there are a few more here. Tax season's here. When are we going to see those taxes? Joe, you want to give an update there?
Yeah, absolutely. So the tax filing deadline, as you know, is for individuals is in April, and the tax filing deadline for us to get the financials and all of our forms in for each property company LLC is mid-March, and in around March 15th typically. And so we're working right now with our accounting team to file all of the property company LLCs that were live in calendar year 2025, and we're getting all of that information in before February deadline that we've set with our team. That way we can start processing those and get those out on time this year. And so that's what we're aiming for, and that's typically the timelines that you can see.
And then we also saw a little bit of a clarification, obviously, around the demand in the K-shaped economy and the affordability component too. And so just diving in a little bit more there and giving a little bit more color is as we look forward, especially in the Airbnb realm, it exactly speaks to that kind of grade A asset class that we play in. If you look at any of the Airbnbs that we have, they're typically going to be the higher end luxury style Airbnbs. And so there'll always be a market to that. Maybe your ADR comes down slightly, but the demand is always naturally going to push up in that realm. So maybe your ADR comes down a little bit. However, we're actually seeing some pretty high demand for our Airbnbs, especially as we're optimizing the algorithm for pricing our Airbnbs out. Now, if you look forward even into the future, a little bit more towards the summer, the World Cup, a lot of our different assets are in kind of World Cup cities, which is going to be tremendously beneficial for us on the go forward. And then not to mention on the pad split, people need a place to stay, whether you're, and there's obviously a tremendous housing shortage, or else Trump wouldn't have mentioned the institutional ban, which brings me to the next question here, which is, it's kind of Ben and Victor came prepared with this, so definitely feel free to add more questions in the chat. Is Trump going to put a freeze on your process? Was Ben. Victor said, with President Trump's proposed ban on large investors buying single-family homes, are there properties in other cities or regions that Mogul's looking to acquire? So two-prong approach. I can cover the first one on the freeze, and then the second one, Joe, if you want to touch on Trump buying, or us looking at buying properties in the home that the institutional investors hold, if that works.
Yeah, absolutely.
So whether Trump is, if he puts, backing up, high level, if Trump were to put an institutional ban on buying single family rental homes, it would benefit us tremendously here at Mogul, and ultimately you all. And what that means is each individual property that we're offering, Mogul itself is not buying. While us at Mogul and all the employees that are working at Mogul are investing alongside you in each individual property, it's not Mogul itself. So Mogul is not an institutional investor in real estate. What that means is when or if Trump were to put a ban on, and it's 100 units or up, or they're actually kind of trying to define it by the end of the month, which again, I think he kind of just threw that out on Truth Social with the hopes that someone would solve for what he meant. But I don't think we fully know what he means right now, because he doesn't know what he means. Anyway, institutional ban, 100 units and up, is kind of like the official, unofficial realm of who is an institutional investor. So because you're investing in individual LLCs that are buying individual assets, it's actually separate from an institutional investor. And so what happens when the biggest buyers of these things are going away, like the Blackstones, the Goldmans, the Tricon, all these different investors, they need somewhere to liquidate. And that's where we come in. We're going to be the only way that they can liquidate without taking massive losses. That's not to say that we wouldn't be able to negotiate some pretty steep discounts. And who knows what the liquidation would be, whether it be immediate or over the next 5 years. However, it would benefit us tremendously. And I think that brings in my next part of the question, which I'll hand off to Joe here. Where are we looking to acquire in light of this potential institutional ban?
Yeah, absolutely. So right now, as you know, typically we're focused in high growth secondary markets with significant price to rent dislocations, right? And what does that mean? It means we can create solid cost bases without lower rents because rents aren't softening as much as some of the capital markets treatment on pricing is in a lot of these markets. Rents continue to go up. People are continuing to move to these secondary markets in these high growth cities. And so in-migration is really strong. Demand for living is still up, even though the market itself is softening. And so markets like the Atlantas of the world, the Nashvilles of the world, the Houstons, the Dallases, those kind of markets that we target right now on a secondary basis have really strong macro fundamentals. And what Trump's proposed ban would do is it would actually create even more opportunity for smaller operators like ourselves. And again, small is relative, right? It's relative to the large institutional buyers that this would truly affect in terms of, large family offices and large private equity shops that aren't able to purchase large portfolios of 100 plus homes, rolled up and capitalized together. And typically what that does, especially on the exit, is it actually floods the market not only with supply, but also with pricing targets. And so it actually affects smaller investors' bases in those markets and actually homeowners that have been in those markets prior, right? And so what that does for us is it creates opportunity, as Alex said, not only from a regulatory standpoint, but also from a macro perspective, because us being a small operator, we're building up those portfolios in markets where, large institutions are either slowing their kind of exposure now, or will even start to sell off, right? And again, when folks start to sell off, and especially if it's a mandated sell off, those will be inherently at discounted prices, or if they're lucky at par, right? And so this suddenly creates more opportunity for us in the short term to buy at solid cost bases. And going through our 5-7+ year holds, that gives the real estate itself time to capital appreciate, right? To achieve that 2 to 3% standardized annual appreciation. When you're looking at it from kind of a linear perspective, obviously it goes up and down, a little bit sinusoidal, as we like to say, but ultimately that will go up and to the right. And so creating this discounted cost basis is great for us as investors.
I just saw in the chat, cough, BlackRock. I love that.
Yeah,
I like getting a little feisty, testy in there. I appreciate that a lot. All right, so I'm gonna rattle off one or two more questions here, and then we should probably get back to the main programming, because I feel like we're gonna be going into this all night, and especially given the fact I agree BlackRock probably should stick to ETFs. Anyway, this one came in on kind of the private comms chat, and this is probably for you, Michael. What happened with the Yamamoto appraisal? The difference is 5.5% lower than presented to investors. Are you going to be updating the new analysis page of the Yamamoto with the new rate of 6.25 under financing assumptions?
Yeah, it was a very, very hard property to appraise in terms of finding comps. It's a log cabin build, and at its scale and the revenue that it generates, there weren't too many others to compare it to, which made it hard for an appraiser to come in on value at the agreed upon sale price. Now, with the more accretive lending terms that we did get, like with the lower interest rate, it still made the investment thesis very strong and in line and slightly even better than what the original thesis was off of the interest rate we thought we were going to get. And then secondarily, we are going to update. We're actually closing on that tomorrow. So once we close on the property, we're going to update the property page with those important details around the lending on the interest rate.
Yep. And also, by the way, BlackRock does invest in real estate as well, as a heads up for people in the chat. I had to triple confirm, because I was like, I swear to God they did. And yeah, since 1981.
100%. Yeah, they have a whole private equity team too.
Yeah, they're not even sneaky big. They're just freaking big. Anyway, let's dive into one last question around the Art House. Dividend payout for the Art House has been pushed out a couple times now, estimated for February. What is the confidence of dividends will we truly pay out then? Michael?
I can take that. Yeah. Yeah. So the art house, the art house. So that was a tough one to get over the finish line, specifically around the lending side. It was a ground up new construction, 10 bed, 10 ensuite bath residential property. And lenders were very iffy to touch it because it was the first of its kind, essentially, especially for that market. So we had to jump around to 3 different lenders to get the deal done. But what's good is that was the guinea pig. The art house walked so the rock house can run, basically. So all the other ones that of that same build in Houston that you see on our platform now, the whole process of closing went so much smoother because of all the hurdles that we had to jump through for the art house and all the lenders that we had to get on board for that type of product. Now, we did just close on the art house last week. So February, there will be a partial dividend. March is when you're going to see a dividend for the full month's operations. But we closed the chapter. We closed the book on the process of the art house. We have it. It's up and running. And you will see a partial dividend February. And again, look to March for the more meaningful one off of full month operations. And there he is.
No way. I'm on?
Yeah, we see.
Let's go. That's absolutely massive. Yeah, we're back. We're so back.
Your background looks like a cross between like a therapist's office and the toilet in like a poorly run restaurant.
It's fake greenery mixed with stuff in the way of a mid move, and then no window. No egress, as state professionals would say.
Is it a yoga studio? Not with his flexibility. Anyway, but actually, I'm starting to do yoga. It's pretty awesome. Anyway, shall we dive into the main event? I mean, what's a Mogul webinar without a surprise? I mean, who wants to do the honors? Joey, business, rising star in real estate, or Michael, who's just been, I don't know what. Pittsburgh.
Not Joey. Yeah, Mike McCarthy enthusiast.
Yeah.
Yeah, I could share it. You want me to do it? Perfect. Okay, so
again, we'll also get to more questions, so feel free to throw them in the chat as well as we continue to go through. God damn, Joey, I've never been so happy to see your face. I'll tell you that much.
You know what? While Michael's pulling that up, I'll just say what happened. I literally I went into settings and was messing around with literally everything, and finally just tried blur background update, and it pops back in. All of a sudden, I popped into picture. Like all the permissions were on. I tried every single browser. Sometimes you just don't know what the heck is going on.
I'm glad to have you now. All right. Without further ado, we're going to launch our newest property, which is a pad split out in Phoenix, Arizona, in Mesa.
Zoom in a little bit on that, Mike?
Yeah.
Like zoom. I don't know how you do that on there. There it is.
Perfect.
Good. Yeah.
Perfect.
So this is currently undergoing renovations by the seller. This is another example of contractor relationships we have in the market with decades-long experience. Know the product that we look for, know the pockets of the Phoenix market that we're most bullish on, and essentially hand deliver us a finished product coming early March with a closing date on April 1st and a dividend date of May. So this is in total 9 bed, 4 baths. There's a main house of 8 beds, 3 baths, and 1 ensuite. And what's typical for the Phoenix area, there's a casita in the back, which is essentially a detached studio apartment. So we're very excited about this, and our Phoenix portfolio on the pad split side is churning over 95% average occupancy. What's nice is the seller is going to get this obviously fully renovated with top-notch amenities, fully furnished, and also going to launch on Pad Split's platform with our property manager a good 3-4 weeks prior to closing to help ramp occupancy. So that they're handing over a well-oiled machine, so to speak, in terms of an operating asset.
Yeah, and if past results are not indicative of future success, but our Rhodes property nearby actually did just pay out was it 1.97, Michael? Is that right?
Yeah, our I think it was just over 10,000 in rents for the month, and what we paid $600K for that asset.
Yeah, that's
right. At the time of purchase. So and caveat, we do need to look at everything with a zoomed out view because November was a little bit lower across the board on pad split side. That's because of the timing of the payouts. As you can see, December was a really exceptional month. Zoom out, look at the average of those 2 months, and then that's smack dab in line and above underwriting on a lot of our assets. So yeah, I can jump into the analysis tab on this. This will break down a little bit more granular on the financials. So year one underwriting has this just shy of 77,000 of post pad split fee income. We, in our assumptions is on the OpEx side, we account for what reassessed property taxes will be. Different markets reassessed at different times. Sometimes this might not even happen until year two, year three. But again, we always approach our numbers with a conservative step. Homeowners insurance as well, miscellaneous costs. Again, as we gather a lot more data on our side and have a lot of assets that fit the similar mold, we know we can get a little bit more exact on how to project out costs such as miscellaneous, which are, the utilities, the leaky faucet throughout the year and things of that nature. Our property management percentage is what it is with our manager in place. And then we throw in the growth rates on the income, operating expenses, and appreciation. We secured the asset for $595. The debt is reflective of 75% loan to value loan on it. This is our standard capitalization from cost reserves in the Mogul fee, and the financing assumptions. So again, 75% loan to value, 6.75% rate. That's today, and usually we can get about an eighth lower than that, give or take, where the market goes from now until when we lock. And our refinance assumptions bring you to the year one walkthrough. NOI just shy of 54,000, bringing a year one levered cash yield just shy of 8.2%.
That's great.
Is there anything that you all wanted to add to this?
No, beautifully said. Again, we're super familiar with this product. We operate a lot of assets in this market and very, very bullish on Phoenix Pad Split product. So really, really excited about this one. Great job, Michael.
Yeah, thanks.
Awesome. We'll open the chat to questions. I mean, do we want to leave it up, or do we want to and maybe go into? Want to leave it up because we're probably going to go through other properties too, right?
Yeah.
Call. Yep.
Yeah, that's great.
All right. So if you have questions, are the interest rates fixed? And then I believe we have a few investors. You want to refresh it?
Yeah. Interest rates.
Good stuff.
10-year fixed IO term. Oh, 12K. There we go.
Nice. I think there should be more though. I keep getting pings on this.
The investment bot. Oh
there
yeah.
Yeah.
Nice.
That's correct.
But yeah, good stuff. Yeah, I mean, let's rip through some of these other questions too. I mean, I'll start with questions about the property, or I'll keep going back and forth about questions with the property.
Should we address the interest rate question quick?
Yeah.
Yeah. So it depends on the structuring. Typically we have 10-year interest only, 30-year amortizing fixed loans. So it will be fixed through the period. Other times there's a what's called typically 5-6 ARM. And what that means effectively is it's a fixed rate for a fixed number of years, being the 5, and then it actually switches to a variable rate thereafter. And so, typically that gives you 5 years to go through your business plan. A lot of our underwritings have those refinances in year 5 of the business plan, assuming that, if it is an ARM structure, it will still be interest only fixed through that initial hold period, just to answer that question. So, long answer to a short question is yes, the rates are fixed.
Incredible. Sorry, I'm answering questions in real time. That way people also get their answers out there. But what happened with Hugo? When is the first dividend anticipated? That's not a bad. Is there fixed? Can you? Anyway, want to answer that one?
Yeah, which one was it?
The Hugo, right? Was that? Huh. I don't know. It's been so long since all these properties are starting to.
Yeah, the Hugo, that's again one example of coming out of the dog days of the slow season, and what we're already seeing is very positive bookings on the go forward calendar. specifically March and beyond.
Perfect. Well, honestly, should we just rip through some more of these questions, or do we want to go through another property? What do you guys recommend? Or honestly, what does the chat think? Either one.
Yeah, we definitely should leave time to answer all the questions towards the end. And I know we already are at the 40-minute mark, which is crazy. So maybe we quickly go through the other properties just to remind everyone what's active, and then we start ripping back through the questions.
Let's do it.
Sure.
Heck yeah. Michael, you want to give a super quick overview?
Yeah. We'll start with the Hoosier, which Sawyer doesn't like that it's called the Hoosier in Tennessee, which Hoosier is for someone from Indiana, right? But that's obviously after Indiana won the championship, we named it. So yeah, this is a already existing short-term rental in Gatlinburg. We acquired this one for 1585. I believe yesterday we got the appraisal back, and I believe it came in $15K higher than the basis we purchased that, which we love to see. This is another turnkey kind of core asset where, we see this was self-managed by the prior seller, which gives opportunity for increased revenue on professional management, and already has a good bit of bookings on the go forward for 2026 that are going to transition day one to Mogul once we purchase. That's
the property manager here is expert in the market, to say the least.
Very much so. Arguably the best one that we got.
Dang, nice.
The next one is the Prost. So this is a newly renovated property for co-living, but it was offered on market, unfurnished, and kind of part of the negotiations on this one, we offered to take it down with the seller not only fully furnishing, but us having total influence over how it's furnished, and also plugging in our property managers to give guidance on the room setups, common space furnishings, and also launching on pad split with those property managers prior to closing to help for a smooth transition and changing hands of the asset. Got this one for $309, and actually negotiated about $7K seller assist post repairs today, post inspection. So getting that at an even better basis with seller credits coming to the reserves post closing. And yeah, this is one that we're excited about. It's in outside of Atlanta, which is the birthplace of pad split, has the most demand in terms of individuals looking to live in a co-living property. So it's a market that we have a good bit of assets in, going to continue getting more, and have a lot of conviction in.
Yeah, and I will say anecdotally, we've been getting a lot of credits across the board, very indicative of the softening market. That's very much a buyer's market right now. So it's been really great. And Michael's done an incredible job with direct negotiation. So excited to see this continue.
Awesome. And then there was one question that I see here specific to the Diamondback. Is that why you went to it, Michael?
No. Just happened to go back to it.
He's seeing the Matrix.
With the question?
This must be what AI is. Anyway, the purchase agreement says March 31st for close of escrow. Is there a reason for discrepancy with the stated April 1st? Also, are there separate contracts for the performance of renovations and onboarding? Is the solar paid?
Solar is paid off free and clear. So excited about that. That'll be reflected in the OpEx on the go forward. I knew this question was going to come up about the purchase agreement. So when I was texting with the sellers who were very close with at this point, they gave us a lot of assets. I thought we said April 1st on the contract. She said, yeah, rather than me redoing the whole thing, let's just slap an addendum on it tomorrow for April 1st. Hence why March 13th is what's showing on the PSA. But it is an April 1st closing. Just saved her a little bit of legwork on the paperwork is all.
Gotta love real estate contracts. Contract law.
Yeah, go ahead.
No, I forget, like the first time I wrote a real estate contract to buy Bowser out in Dallas, I put it on a single family rental contract instead of on a condo contract, which, and I was trying to act like way ahead of my steez, so to speak, to the other realtor. Like I had done this a million times before, and then she had to quietly call me and say that I had done that. So anyway, real estate contracts are one hell of a beast.
Love that. And just to round that question off too, closings, typically move forward and back a little bit according to the purchase and sale agreements. But if you do see it fall into another month, that's when you'll see the operational dates shift in the portal. So definitely keep an eye out, because you'll see dynamically the property's operational start date shift if a closing gets pushed into another month. So just keep a lookout there.
Definitely want to jump around also to questions. Jennifer mentions that, wait, were you good with that, Jay? Can I go?
Yeah, all good.
Here we go. When I look at pad splits, I think about the number of bathroom per person as part of my investing criteria. Have you noticed that if there are 8 to 10 bedrooms, but only 3 to 4 baths, some people are more reluctant to rent in that space? Could that impact returns value? Also, in some properties, there aren't photos of the kitchen, living room, not all, of course, but enough to make me curious. And then there was an angel emoji afterwards, irrelevant to the question, but who wants to get that one?
Yeah, I mean, I could take I think the first part of it. Yeah, I mean, there's demand for properties. We don't own any, but there's properties out there on the Passable platform with 11 beds and 2 bathrooms, things of that nature. We like to keep it within typically 3 beds to a bathroom. Now, yeah, I will say there is a market for those highly populated and densely populated properties. But those bedrooms usually come at a lower nominal weekly rate, which allows folks to have, a roof over their head for a price that they can afford. So that's something that, I don't know, maybe not a lot of people would be willing to do, or conditions to live in terms of how many people they have to share a bathroom with. But it definitely fits for a lot of folks looking for an affordable place to live.
Yeah, it translates, right? Because like more baths, definitely more premium, but you're also paying a higher premium for that property inherently. So like, yes, your rents are higher, but your yield is relatively similar, and occupancy is definitely similar. There's, as Michael said, demand across the board for both types of product, but there's a sweet spot. That you start to see more discrepancy, as Michael said, when you get outside of the 3 bed to 1 bath, excuse me, and then obviously anything in the 1 bed to 1 bath is just you're paying the highest premium up front, and you're ideally achieving rents, but there's also a little bit more risk, right? Because you need to continue to achieve those more premium rents with a more co-living product. So it all translates, and the cost basis takes that into account as well.
Definitely. And also, Larry, if you want to throw in the Diamondback, it's been a while, and it's if people don't want to go back up to the top, and so Larry mentioning the blueprints, he's so proud of the blueprints, all of that. What else do we got? All right, let's just rip from the top. I think we're gonna do rapid fire here. Joey, you can speed up a little bit too on this one.
Permission granted.
Yeah, here we go. All right, I'm trying to go to the top because I feel like it's got to be are all the properties using depreciation cost seg and other deductions to report paper losses for tax purposes? If not, are there certain properties that do this? I ask because my goal is to continue reporting losses and carry forwarding losses indefinitely to avoid taxes. I mean, I can take this real quick. Case by case basis, again, really depends on the property. It really depends on the yield relative to the price of the property. We want to obviously maintain a passive loss for income reporting purposes for a lot of these ones. And so our goal is to kind of analyze it on a case by case basis. I can say last year that all our properties recorded a paper loss, even though they all made income, which was great. Can you please clarify this number? Was that ROI of 1.2% approximately? To be honest with you, at 1.2%, it sounds like a monthly figure. I'm just going to throw that out there.
Cash yield, monthly cash yield. It's probably what they're.
Yeah. So closer to kind of the 14% range. And then how often are the Mogul properties appraised? If an appraisal is done, will I see the value of my investment updated in the Mogul platform to reflect the new appraised amount? So I'm thinking they're talking about mark to market, right?
Correct.
So that one's done on a monthly basis. It really has to be like, as with real estate, prices don't move and they don't fluctuate all that much. It really is like month to month. And even then, maybe it's a 5K here, 5K there difference. And it depends on the comps you're looking at, all those. So while we do keep it mark to market in real time, we obviously want to be realistic with it. And so you will see it updated in your portfolio if there's a bigger swing than kind of like a $1,000 swing here and there. Joe said something in the chat. disappointing. Every property is a pad split or STR. If this model collapses, all your eggs are in one basket. I mean, Joey, do you want to? Those are fighting words. Do you want to talk through it?
Yeah, appreciate you per usual, Joe. I will say, so we are looking to expand into additional product. Right now, we're looking at high density, low purchase price LTRs, actually, which will be kind of your long-term rental, triple net leases to the tenant, very easy to manage, similar yield profile to, I would say, the STRs, and then the capital appreciation is very solid because it's a known product, and lenders love it, investors love it. It's pretty easy to sell, it's pretty easy to buy. So we are out in the market for those now. Definitely expect those to be coming soon as a sneak peek here. And other than that, yeah, you'll continue to see more product come online. Right now we've had a lot of early success with pad splits and with STRs, and single family rentals is the name of the game. That doesn't mean we won't eventually expand into other areas of residential real estate, whether it is multifamily or other creative forms of leasing up these assets. We didn't think we'd be in the co-living space, but here we are. It's one of our strongest operating product, and a year from now, who knows? There might be 6 different product types on the platform. We'll see.
Yeah, and then also I will mention too, single family rental, you can adapt and change your business model accordingly. And so, I mean, think about the co-living space and pad split. I mean, it applies to student housing, workforce housing, just traveling nomads, all these different things. So definitely something to consider there. Geez. All right. Do we think I scroll up to the top, or I just kind of rattle through the questions here? These things just keep coming in.
Yeah, go ahead and just keep rattling.
All right. Are there solar panels on the Diamondback roof? That we already answered. Feel free to send it back in the chat. I can't really scroll through all the way to the top. When do you expect to enter other new markets? Nashville, Carolinas, East Coast. Someone, 2 sentences.
Yeah, we're actively looking at a handful of different markets that we don't yet have assets in, just kind of looking for that right one, and not entering a market just for the sake of entering, but doing it with a strong asset that we have high conviction in. As we build out our team and our networks and boots on the ground in these markets, we're seeing more and more deal flow. And Nashville, definitely one of the markets we're looking at. The Carolinas as well post a lot of opportunity. So yeah, always looking to more markets where the data supports it.
Data.
Data. I see 3 or 4 questions about the secondary market, Alex, if you want to address that.
Secondary market, we're obviously continuing to look into it. We want to make it fully liquid. If we're going to launch a secondary market, we don't want it to basically be some peer-to-peer marketplace with speculative bid-ask spreads. And so the way that we would do it is come in and actually provide liquidity as a market maker in the space. And so we are looking at for later this year. It really, again, the actual technical development of it, pretty easy to do. The logistics behind it and the actual financials behind it, you basically have to get a line of credit in place. And so towards the end of this year is actually when we're going to be at kind of the size, so to speak, where it will become easier to get a line of credit that will be able to provide that instant liquidity. So just something to consider there. All right. Some of these other ones too. Jesus. All right. I'm just going to start going from the bottom to top. Like the pad split without brand. Is Mogul looking into the Los Angeles market? No.
So we're not currently actively looking to pursue deals in the Los Angeles market. Are we underwriting them and keeping them in our back pockets? Absolutely. And if the right opportunity arose, we would definitely look into it. There are just a lot of hurdles. One being insurance right now. Obviously, fire insurance or dwelling insurance in general and flood insurance are really, really hard to come by in California. Hence, the news last year with the fires and obviously the California Fair Plan being bankrupt. That's really, some of the hurdles that we would need to go through to do that, but we are constantly underwriting it. So stay tuned.
Yep. And then total number of property closed on Mogul. Someone have that? Like 30
changes by the day.
Yeah, 30 or 40, I think at this point.
I know we've more than 2x the amount of properties on platform since July of last year. So that's a fun little tidbit. I mean, over 50.
Yeah.
Yeah, we should probably keep that track of that, huh? We're just concerned with going to get the next one that we're not really counting the chickens we have.
Are the December property breakdown summary coming? Not showing yet on the website. It should be shown there. I mean, it showed for me at least. Maybe reach out to our sport team. More than happy to help out there. When did Mogul start? I mean, in all candor, we kind of started beginning of 2024, right? Was like when we first officially launched the relaunch of the platform, I would say. God, there's just so many. I kind of went fully out of order. All right, here we go. When I go to the Mogul website, yep, click on the Diamondback. We've got that. How important is curb appeal to you? Do you ever invest in landscaping, staging, et cetera, to beautify the outer appearance, et cetera?
Yeah, I mean, that's definitely part of the value add that we put into the properties, or the expectations we set with sellers that are handing us a fully renovated asset. So yeah, the curb appeal speaks to the quality of the assets. So that's definitely something that we keep a close eye on.
Incredible. I'm not seeing December either in the breakdown. Let me pull it up. That's weird. It is coming up for me. Let me double check on that. We can get that going. Yeah.
Aton's on it.
Yep. Aton is already on it, which is great. I appreciate your commentary on the California market with respect to insurance costs. What do you believe are the biggest hurdles to additional investment in the Florida market? And are there pockets of value in the state that show promise?
Yeah. I mean, the biggest hurdles are just finding the right assets. I mean, we've had some interest in some STRs on the Gulf Coast, even the past week or two. We may or may not have gotten a couple pad splits under contract as of yesterday. So definitely more coming out of the Florida market that you'll see on platform. Sorry if I overshared on that one, Alex.
No, yeah, super exciting. I will say insurance costs, when they're exorbitantly higher in markets, the yields just have to justify that, right? As long as the NOI margins check out, that's all that matters. So higher insurance costs just means that we have to qualify with higher rents. That's it.
Yeah, and ideally, we're looking to avoid flood zones in Florida. Now, granted, if it's a short-term rental and it's on the water, that's kind of, you have to bite the bullet on the flood insurance being needed. But as long as the property underwrites favorably with those costs in mind, that's kind of what we look for.
Incredible. And then if anyone has any last questions to throw in, we got 2 minutes left here. I know obviously we tried to get to as many as we can. As someone trying to start investing with Mogul, is there an option to pull out my investment anytime I want? And how does that work? Again, that's the secondary market. Real estate is an illiquid investment. We are trying to make it more liquid with a secondary exchange. Typical period is about 5 to 7 years. Any update on the WAGs? Joey, you want to give one?
Yeah, absolutely. So just as a quick reminder, the WAGs is going through a title claim insurance kind of debacle. It was actually a really interesting story, but update on the settlement is that the final judgment is being awaited from the court right now, and everything is looking up in our favor. So it's just a matter of getting that settled, and then we can start processing next steps for the investors in that asset.
Yep. Again, we'll try and keep you updated as much as possible. We're waiting on the last thing. Okay, Lando shows this month, but currently blank.
Yeah.
Any update?
Lando closed on the 29th of December. So there were 2 days of it in our ownership. So it just wasn't enough to produce a dividend or provide a report. You'll see it on February, last Thursday of February for the first dividend on that one.
Yeah. And I will say, we get curious, what is average investment per investor? So I can set target to meet. Typically people go in for like 10K per property. We obviously initially set out to do investments that anyone can invest. But again, it's more so of people saw the returns and started investing multiples of their first investment. We're coming up on time here. One last try. Do you file state composite returns for each property? Joey?
State composite returns for each property?
We just file at the LLC level, right?
Correct. Exactly. Yeah. All of our LLCs are filed in Delaware. So we file all of our returns simultaneously across every property co LLC.
Yep. And Brad, can you guys put the pad split link in the property page or Airbnb link? We're actually in the process of adding a few more cool features by later this quarter, if not beginning of next, which will allow you to actually book directly through us. And so I hope I didn't give away too much there. But anyway, it'll be some fun stuff. But outside of that, I mean, we are up on time. Again, if you didn't answer your questions, or sorry, this was the first time, at least I've been here, where we just keep getting more questions. So I do appreciate, obviously, the enthusiasm here. Appreciate everyone joining. Joey, Michael, you got anything, last thing you want to say?
Really appreciate everyone. Sorry again for the technical difficulties. It only seems to be when Alex is on that happens to me. So we'll make sure that it doesn't happen again. I'm kidding. I appreciate you all so much. Yeah, it's been great. Michael, anything else?
Yeah, no, thanks everyone for joining. We say this every webinar, but any suggestions you ever have about how to make the platform better, we're crafting it with you all in mind and your suggestions at heart, and having a heck of a lot of fun doing it. So definitely don't hesitate to reach out with any value add suggestions, and thanks for coming along of the ride with us.
Actually, I'm getting a message. Why don't we, Larry, can you screenshot all the questions in the chat that we didn't get to, and then we can reach out to these people individually?
Yeah,
That would be a great call. Larry, you still there? I hope to God you are. Anyway, all right. Thank you everyone for joining. We will be sending out the webinar link afterwards. So appreciate you all joining. Take care.